In this video, we're going to discuss how to calculate a predetermined overhead rate. But first, we should probably understand why we need to have a predetermined overhead rate. For example, why don't we just wait till the end of the period and see what overhead is then so that we have a more accurate figure? Well, the thing is, we have to remember that cost accounting information is intended to be timely and relevant. And even if we have to sacrifice some accuracy by not waiting to the end of the period, it's more timely if we can get the data, get the numbers right now, even if we have to use an estimate, right? Which is ultimately what we're doing with a predetermined overhead rate. We're coming up with a budgeted idea, an estimate of what the overhead is going to be, and then we're applying that. So the reason that it's more timely or more relevant information is that, let's say a customer comes to us. Let's say that we manufacture furniture, right? So we have a small place that we build custom furniture for people, and someone comes in and says, okay, I want to know how much it would be if you could give me a quote for a bookshelf. So if we're going to give this person a quote, do we say, okay, well, come back at the end of the period and then we'll know what the overhead was, and we'll be able to give you an accurate quote of what you owe us? So of course not, right? They're going to want a quote now or tomorrow or sometime in the near future, and you can't just wait to the end to see, well, the accurate totals of what the overhead were. So you need some kind of way to estimate right now. Additionally, overhead costs, and I'll just abbreviate OH, overhead costs tend to fluctuate over time, some of them. And this isn't all. I mean, remember, overhead costs we're talking about a really big pool of different kinds of costs here, but let's take one type in particular, utilities. So we think about, for example, do you think that it might cost more to heat our factory or our building in the winter? Okay, now, so if it's December and we're trying to calculate the overhead right now for this month, and we say, okay, this will be more accurate. Well, now the jobs that we're giving quotes on are going to look like they're costing us more. It's more expensive to do a job in winter as opposed to February, or excuse me, as opposed to July or some month other than December. So we're really not wanting to capture any kind of these fluctuations or anything like that. We really just want a way to give kind of a standard quote and say, okay, here's what it's going to cost to build this bookshelf. We're going to have some direct materials, we're going to have some direct labor, and we're going to have some overhead. Here's the total cost based on those figures. So now that we kind of have a rationale for why we would be calculating a predetermined overhead rate instead of just waiting to the end of the period and seeing what actual overhead is, let's go and actually calculate a predetermined overhead rate and see how it actually works out in practice. So for our example, let's say that we have a manufacturing plant, a factory that makes two things. It makes cars and it makes trucks. So we've got these two different divisions at our factory. And so someone comes, I know this isn't common, but let's just say someone actually wanted a quote for one car from this factory, a quote for one car, and the factory says, you know what, we're not going to give it to a dealership, or we'll just directly deal with you. We'll give you a quote for this one car. And you're saying, okay, that's great. Let's see the quote. So on that quote, they break it down, and you've got raw materials, right? This is the steel and everything to build the car. That's $5,000. And then the direct labor, I'll just abbreviate DL, that's $3,000. And then the manufacturing overhead, I'll just MOH, and that's what we're trying to figure out. So we say, how much do we charge to overhead? How will we go about calculating a predetermined overhead rate? How will we go about applying it? And we're not taking into consideration profits or anything like that. This is just simply, they're just giving you an estimate of the cost, right? So the cost for one car. So the overhead, in terms of getting this predetermined rate, first thing we need to have is something called a cost driver. A cost driver. It's a very important concept. A cost driver could be a lot of things. Some common things that you'll see be something like machine hours, the number of hours that a machine is running, labor hours, but it could be a number of things. In a hospital, it could be the number of beds occupied. In our case, let's use labor hours. Now, the idea behind this should be that whatever we're choosing as our driver should be something that has some kind of relationship to the actual overhead. And the idea being that more labor hours implies more overhead. Now, certain things, as we just talked about, utility expense, it's going to be difficult to find that relation. But remember, there are a lot of things in overhead. It's a big pool. So there's something that's driving overhead costs, right? If we run the machine more, then it costs more for overhead. We know the relation's not going to be perfect, right? These things are in overhead because they're not directly traceable to begin with, but we want some kind of relation. And so we're going to use, at our firm, we think, okay, labor hours is the best cost driver. So what we do now is we say, okay, well, regarding these labor hours, what is the budgeted amount for the year? And then what's our budgeted overhead? So let me just write out the little equation we'll have here. This will give us our rate is budgeted overhead, and then divide that by our budgeted cost driver, which in this case is going to be labor hours. And by budgeted, I mean these are estimates. Now this is going to yield, this is going to give us our rate. I'll just say our let me just abbreviate that there. Okay, so let's say that we estimate that during the year, we look forward and say during the year we're going to have $4 million in overhead. We know that's not necessarily going to be spot on. That's our estimate. And then in terms of the labor hours, we think that we'll have about 100,000 labor hours. Okay. Now, we just do a little division here. That gives us $40. And what is this $40? That's $40 of manufacturing overhead applied per labor hour. Right? So this is our rate. This is our predetermined rate. So for every labor hour that we incur, every time someone works an hour of labor on a job, we're going to apply $40 of overhead to that job. Okay? So let's say that these $3,000 of direct labor, or let's just say that that was based on 100 labor hours. 100 labor hours. So people worked for 100 hours to build this car. We have no idea if that's a good estimate or not, but that's what we're going to use. So now we just say, okay, well, this manufacturing overhead, now we have to use our rate, which is that $40 that we just calculated, multiply it by the actual number of labor hours, right? That's a poor looking dollar sign, I apologize. So we take this $40 and we say, okay, that's the rate, and now we just apply it, multiply it by the 100 labor hours, and that gives us $4,000. Now again, this is not the actual manufacturing overhead. This is the amount of applied manufacturing overhead. This is how much we have applied to this job. Okay, so we just say we use our estimated overhead or estimated labor hours to give us a rate per hour, right? And that's that $40. Then multiply as we incur actual labor hours. We say that they are driving the overhead. And so we apply it 100 hours at $40 an hour, 4,000 manufacturing overhead. Now, if we look now, we want to do this quote just for completeness sake. Now we'd have 5,000 plus 3,000 plus 4,000, $12,000 we would quote as the cost to build this car.